Chapter 1. Introduction. Welcome to AI Finance Mastermind, your trusted source for the latest financial insights and investment strategies. Today, we focus on a critical concern facing the global economy in 2025, stagflation. On June 3, 2025, J.P. Morgan Chase issued a stark warning about the potential for stagflation in the United States, a rare and troubling economic condition characterized by stagnant economic growth, rising inflation, and increasing unemployment rates. This warning carries significant implications for investors everywhere. Stagflation poses unique challenges, as it defies traditional economic logic and undermines conventional investment strategies. Understanding what stagflation is, why it might be returning, and how to prepare your investments accordingly is essential for protecting and growing your wealth in an uncertain environment. In this video, we will explain the nature of stagflation, review the key signals J.P. Morgan has identified, analyze its effects on different asset classes, and discuss practical investment strategies to help you navigate this complex economic terrain. By the end, you will have a clear understanding of the risks and opportunities stagflation presents, and the knowledge needed to position your investments wisely. Chapter 2. What is stagflation? To appreciate the significance of J.P. Morgan's warning, it's crucial to first understand stagflation itself. Stagflation is an economic state in which high inflation coexists with slow or negative economic growth and rising unemployment. This is unusual because inflation and economic growth typically move in tandem. When growth is strong, prices tend to rise due to increased demand. When growth slows, inflation usually eases. In stagflation, this typical pattern breaks down. The economy experiences both stagnant growth and rising prices simultaneously, creating a particularly difficult scenario for policymakers and investors. Central banks face a dilemma in stagflation. To combat inflation, they typically raise interest rates, which cools economic activity. However, this tightening can exacerbate economic stagnation and unemployment. Conversely, efforts to stimulate growth through monetary easing may fuel inflation further. Historically, stagflation was most prominent in the 1970s. During that period, energy price shocks caused inflation to soar above 10%, unemployment rose, and economic growth stagnated. The lessons learned then remain relevant today, as investors face echoes of similar challenges. Stagflation disrupts both markets and consumer behavior. Rising prices reduce consumers' purchasing power, while companies face higher costs and squeezed profit margins. For investors, stagflation demands a reassessment of traditional portfolio assumptions, as many assets react unpredictably under such conditions. Chapter 3. J.P. Morgan's warning signals. J.P. Morgan Chase's strategists, including senior analyst Mislav Matejka, have identified several key economic signals pointing toward stagflation risks in 2025. Let's explore these in detail. 3.1 Trade tensions and tariffs. The ongoing trade disputes between the United States and China have intensified, resulting in increased tariffs on key goods such as steel, aluminum, and consumer electronics. These tariffs disrupt global supply chains, increasing costs for manufacturers and consumers alike. Supply chain bottlenecks continue in many industries, delaying production and raising prices. These disruptions feed inflation while simultaneously dampening economic growth and business investment. 3.2 Weakening consumer confidence. Consumer spending drives roughly 70% of U.S. economic output. Despite solid growth in prior quarters, surveys show that consumer confidence is waning. Forward-looking indicators suggest that households may cut back on spending in anticipation of tougher economic times. Lower consumer spending reduces demand, slowing growth and exacerbating the stagflation problem. 3.3 Persistent inflation. Despite tightening monetary policies, inflation remains stubbornly high. Elevated prices in energy, food, and raw materials continue to strain household budgets. Core inflation metrics, which exclude volatile food and energy prices, also remain above target levels, suggesting inflation is broad-based and persistent. 3.4 Rising bond yields and fiscal deficit. Inflation fears and rising government spending have pushed bond yields upward. Higher yields increase borrowing costs for corporations and the government, dampening investment and economic growth. Large fiscal deficits and expansive monetary policies add to market concerns about debt sustainability and inflation. 3.5 Overly optimistic earnings projections. J.P. Morgan warns that corporate earnings forecasts may be too bullish. If companies fail to meet these optimistic projections amid stagflationary pressures, equity prices may correct sharply. 3.6 High market valuations. U.S. equity markets continue to trade at high valuations, leaving little cushion for economic shocks. Elevated price-to-earnings ratios increase vulnerability to volatility if stagflation risks materialize. Chapter 4. Jamie Dimon's perspective. Jamie Dimon, CEO of J.P. Morgan Chase, has emphasized the serious risks posed by stagflation. He highlights the dangers of ballooning government deficits, geopolitical tensions, and persistent trade conflicts. Dimon warns that the combination of excessive fiscal spending and aggressive monetary tightening risks triggering a crisis in the bond markets. If investor confidence deteriorates, bond yields could spike, causing turmoil in financial markets. He stresses that responsible fiscal management and coordinated monetary policy are essential to prevent such outcomes. Dimon's views reinforce J.P. Morgan's broader warnings and underscore the complexity of the current economic landscape. Chapter 5. Historical lessons from the 1970s. To better understand stagflation, we must look back to the 1970s, when it last appeared prominently. That decade was marked by two major oil shocks caused by geopolitical conflicts, which quadrupled energy prices worldwide. Inflation soared, unemployment rose, and economic growth stalled, creating a painful period for markets and households. Central banks struggled to manage the conflicting goals of fighting inflation and supporting growth. The 1970s teaches the importance of diversification, focus on quality assets, and the dangers of complacency during times of economic stress. Chapter 6. Impact on asset classes. Stagflation affects asset classes in distinct ways. Understanding these effects is key for portfolio management. 6.1 Equity stocks generally face headwinds during stagflation, as sluggish growth reduces corporate earnings. However, some sectors tend to perform better. Consumer staples, products like food and household goods see steady demand. Energy and materials. Rising commodity prices can boost profits. Healthcare, often less sensitive to economic cycles. Growth stocks and companies with high debt loads typically struggle more due to higher interest costs and slower demand. 6.2 Bond prices typically decline as inflation erodes fixed income returns and rising interest rates increase yields. Shorter duration bonds tend to perform better by minimizing interest rate risk. Inflation-protected securities, like Treasury inflation-protected securities, TIPS, can offer protection against rising prices. 6.3 Commodities, particularly precious metals like gold, often outperform in stagflation. They serve as hedges against inflation and store value when currencies weaken. Energy commodities also benefit from higher prices amid supply constraints. 6.4 Real estate has mixed outcomes. Rental incomes may rise with inflation, providing income protection. However, higher interest rates can pressure property prices and slow market activity. Chapter 7. Practical investment strategies. Investors should consider adjusting their portfolios to manage stagflation risks. Diversify across stocks, bonds, commodities, and real estate. Focus on quality companies with strong balance sheets and pricing power. Increase allocation to inflation-protected bonds. Maintain liquidity through short-term bonds and money market funds. Seek international exposure to markets less affected by stagflation. Explore alternative investments, such as infrastructure or private equity. Diversification and quality focus help reduce risk while positioning for inflation-related opportunities. Chapter 8. Monitoring key indicators active investors should watch. Inflation rates and Consumer Price Index, CPI, data. Unemployment trends. Central bank policy statements. Corporate earnings reports. Consumer sentiment and spending data. Trade policy developments. Regular monitoring helps timely adjustment of investment strategies. Chapter 9. Managing volatility. Stagflation often brings increased market volatility. Maintaining discipline and avoiding emotional reactions are critical. Staying focused on long-term investment goals and fundamentals is key. Volatility also creates opportunities for savvy investors. Chapter 10. Conclusion. JPMorgan's stagflation warning highlights the need for awareness and strategic planning. Investors who understand stagflation's challenges and adapt their portfolios stand the best chance to protect and grow wealth. Diversification, quality focus, liquidity, and informed decision-making are crucial. Stay alert, stay flexible, and remain informed. Chapter 11. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always consult a professional financial advisor before making investment decisions. Chapter 12. Subscribe for more insights. Thank you for watching. Subscribe to AI Finance Mastermind and hit the notification bell to stay updated on critical financial news and strategies.